Why are mortgage rates still so high?
Mortgage rates are up again.
Mortgage rates are slightly higher today.
Mortgage rates are still on the rise.
In 2024, the Fed slashed interest rates not once, not twice, but 3 times, and you think the rates would follow, right? Think again, they're still sitting so annoyingly high. As an investor, what is the next move? Do you sit on the sidelines and watch, or figure out how to cash in despite the rates? Why are we so passionate about this topic? For the last 6 years, we've done nothing but buy multifamily properties, over 300 million worth. We've navigated every type of loan structure, interest rate swings, and market conditions you can imagine. The result? We've learned how the rise and fall of interest rates can make or break a deal, and more importantly, how you can win big even when rates aren't in your favor. Let's break it down so that you don't just survive the market, you dominate it. But first, to understand this, let's go back a few years. The origins of the interest rate shock. In 2019, the US economy was booming and interest rates were relatively stable. But then the pandemic hit in early 2020 and everything changed. To avoid a total economic collapse, the Federal Reserve slashed interest rates to near zero levels and pumped trillions of dollars into the economy through stimulus packages. This created a flood of liquidity and the real estate market entered an unprecedented boom. The investors moved quickly to take advantage of low financing costs, driving property valuation to record highs and compressing the cap rates. But what no one could have predicted was the speed and magnitude of the interest rate hikes that followed. When inflation surged in 2022, the Feds, they've pivoted to an aggressive rate hike strategy that was the fastest and unprecedented, hadn't been seen in decades, catching the entire market off guard. This rapid shift brought bridge debt to the forefront of real estate financing. What do I mean by this? Typically, agency lenders like Fannie Mae and Freddie Mac are the backbone of the multifamily financing. They offer long-term stable loans. However, after 2020, their lending activities dropped significantly by nearly 33% as they tightened the underwriting standards and pulled back on the loan volumes. Their combined loan volume, for example, dropped from 148 billion in loans in 2019 to 100 billion in 2023. This created a financial gap which bridge debt providers filled. Bridge loans were a practical solution at the time, offering flexibility and quick closing in a competitive market. They allowed investors to secure properties, make value-add improvements, and position for long-term refinancing. However, these loans came with short terms, typically 1 to 3 years, meaning many of these loans are now approaching maturity. Floating rates, variable interest rates that were manageable in low-rate environments but soared as rates rose. Higher leverage, designed for projects with clear value-add potentials, assuming stable market conditions. At the time, bridge debt was a logical and widely used tool across the industry. Few would have anticipated how quickly and drastically rates would climb, creating a challenging environment for borrowers. Now that you understand how all this started, let's discuss the obvious elephant in the room. The disconnect, the mortgage rates versus the fund rates. To understand why mortgage rates remain high after the Fed cuts interest rate, we need to look at what actually drives mortgage rates, and it's not as simple as the federal fund rate. Historically, mortgage rates have been more closely tied to the performance of mortgage-backed securities, MBS, and the US Treasury market, particularly the 10-year Treasury yield. Here's why. Mortgage-backed securities, MBS, the MBS are financial instruments that bundle home loans together and sell them to investors. Lenders use these securities to fund mortgages, meaning that the returns that the investors demand on MBS directly impacts mortgage rates. When demands for MBS drops, prices fall, and the yields or interest they rise. Conversely, when demand for MBS increases, prices rise and the yield drops, leading to lower mortgage rates. Think of MBS like a box of chocolate sold at an auction. You can never just eat one. The chocolate represents home loans, and the box, MBS, bundles together for sale. If a lot of people, investors, are excited to buy the box of chocolates, the bidding war drives up the price, and the seller, aka the lender, doesn't have to offer an extra incentive, aka higher yields, to make the sale. This is like when MBS demand is high, price rise, and mortgage rates drops. If a few people want the box of chocolates, the seller has to sweeten the deal by offering a better incentive, higher yields to attract buyers. This happens when MBS demands falls and prices drops and mortgage rates rises. So just like an auction, the level of interest demands determines how much extra value, yield, is needed to close the deal, and the extra value directly affects mortgage rates. Thus, during times of economic uncertainty, investors flock to MBS as a safer yield-generating alternative to stocks. This demand pushes MBS prices higher, lowering yields and in turn reducing mortgage rates. However, in a period of high inflation or economic instability like we've seen since 2022, demand for MBS can falter. Investors demand higher yields to offset the risk, driving mortgage rates higher. Beyond MBS, the US Treasuries are another critical factor. Mortgage rates tend to track the 10-year Treasury yield because both are considered long-term investments with relatively especially low risk. When treasury yields rise, mortgage rates often follow, and vice versa. Here's the key: the federal funds rate influences short-term interest rates like credit cards and car loans, but mortgage rates are tied to longer-term expectations, including inflation, economic growth, and the Federal Reserve policy direction. So back to the original question at the start of this episode: is it time to press pause and bench yourself on the sideline? Although interest rate may remain higher than ideal for the foreseeable future, this could actually be a golden opportunity for smart real estate investors. Let's break it down. According to CRE Daily, an estimated $83.4 billion in loans is set to mature in 2025, with nearly $90 billion more in 2026. Those are massive numbers, and it's where things gets really interesting. Some deals will thrive, those with strong operations and solid fundamentals. These properties might struggle in the short term, but the lenders are often willing to modify adjustable rate loans arms to help these deals survive. The biggest issue? Many of the less lucky deals lack proper capital reserves. With bridge loans maturing and no clear exit strategies, sellers may find themselves forced to sell at steep discounts just to avoid foreclosure. These deals, unfortunately, may not make it. These were the ones that were bought at inflated prices with weak fundamentals, properties with low NOI, and over-reliance on cap rate compression to create value. They were risky bets from the start, and now the rising rates are exposing their flaws. And if you listen to these terms and you're wondering, Palmy, what gibberish are you talking about? Don't worry, we have a free course inside our community, Wealth Beyond Me, that can help you with this. If you're interested, the link is in the description. The Smart Investors Playbook. Let's talk about our playbook that is helping us navigate and excel in these choppy real estate waters. For us, it starts with focusing on A-class assets. Property with strong rent-to-income ratios, typically 6x the rent compared to tenants' monthly income. This is a stark contrast to C-class assets where tenants typically hover around a 3x ratio, leaving them with far less financial cushion and adding more risk for investors. So one of our multifamily properties, the average median income is $180,000 per year, which is around $15,000 gross income. Our rent is around $2,000, which means that their income to rent ratio is 7.5x. This is a very healthy ratio. We also target properties that are underperforming due to structural debt issues or poor property management, not because they're fundamentally bad assets. This is the key distinction. We're looking for opportunities where operational improvements or strategic debt structuring can turn the struggling property into a thriving one. When lenders aren't willing to modify the terms, or when there's a clear path to improving operations with better management, these properties can often be purchased today at a 30 to 50% discount. And once interest rates starts dropping again, these assets are poised for substantial value appreciation. Who would say no to that type of deal? What's especially exciting right now is the broader market trend. Capital is flowing back into commercial real estate. After years of uncertainty following the pandemic, funding has made a strong return, especially in 2024. Loan volumes are expected to jump 26% this year, reaching $539 billion, according to Mortgage Bankers Association. This influx of capital is helping to stabilize the market and, in many cases, putting a floor under the property price. Debt funds, in particular, are stepping in big time, filling the gaps left by traditional lenders like regional banks, many which have scaled back their activities following the failures of several banks in 2023. As Diana Broomer, co-chair of Goldman's Real Estate Group, put it, there are many more opportunities than there used to be for financing outside of the traditional banking system. What's driving this surge in capital? Several factors. Short-term debt solutions. Lenders favoring short-term financing, often 5 years or less, which provides flexibilities for both the borrower and the lender. This type of financing allows landlords to refinance or sell if rate drops while protecting lenders from long-term risk. High yields. Commercial real estate now offers some of the most attractive yields seen in the past 15 years. With properties valued below pre-COVID levels, adjusted for inflation, many assets are trading at prices lower than during the global financial crisis of 2008 to 2009. Michael Acton, head of research and strategy at AEW Capital Management, noted, "We're looking at probably the best entry point in commercial real estate in 15 or 20 years. Yields are the highest they've been in over a decade." Why now is the time to act? This shift in capital flows shows that the big players in real estate, the ones who truly understand market cycles, are already positioning themselves for the next wave of opportunities. They see exactly what we're talking about in this episode: a chance to acquire high-quality assets at significant discounts with the potential for substantial appreciation as the market recovers. For real estate investors like us, this environment reinforces the importance of strategy. As Acton said, if you don't have capital, you've got a real problem. The good news, for those with a strategic playbook and the ability to act boldly, this market represents an unprecedented opportunity. The question is, will you seize it? If you're curious about how the world's largest asset managers are playing their hands during Trump's second administration and how you can apply their strategies, don't miss the next video. See you there.